Hello, everyone, and welcome to our presentation for this week's material. This week's material will focus primarily on the topic of financial statement evaluation. As with any finance course, financial statement evaluation is going to be one of the most important topics discussed, as every topic thereafter will build from it. For this reason, it is one of the first topics we will look at going forward. And throughout the remainder of the course, we will refer back to the topics and theories discussed therein. Let's get started. First, it's important to understand the three primary, otherwise stated, major financial statements. Those three are typically thought of in terms of the income statement, the balance sheet, and the statement of cash flows. The income statement, as the name implies, is the statement that shows the firm's revenues and expenses during a specified period. This specified period typically is annually, but can also occur on a semi-annual or monthly basis. It is through the income statement that we would derive such numbers as additions to retained earnings, dividends paid, and what is oftentimes thought of as the bottom line or the net income made from the revenue coming through the company. The balance sheet is the accounting statement of a firm's financial position at a specified time. Typically, the top of any balance sheet will read for the year ended December 31st and the year. This is to denote that everything detailed on the balance sheet is from the year prior. The balance sheet is referred to as the balance sheet because, as the name implies, it balances. On the left side, you have all of the assets that a company has, such as the things that it owns, cash, etc. On the right side, you have what is referred to as liabilities and equity. On the left side, we find that it equals the right side. So assets equals liabilities and equity. Therefore, the left side and the right side balance or are equal to one another. The reason this is because the assets represent everything that the company owns. The right side represents how these items have been paid or financed. Lastly, we have the statement of cash flows, which is the financial statement that shows the firm's cash receipts and cash payments during a specified period. As with the others, this can be monthly, semi-annually, or annually. Here we have a breakdown chart of the ability to measure a firm's performance. All of these are different ways through which a firm's performance can be measured. During our presentation this week, we will only focus on a couple of these. As you'll recall back, the overall goal of any firm is the maximization of shareholder value, which is why we find that on the top of this breakdown. One of the more important categories that we will look at during this presentation are liquidity ratios, as well as a couple other key areas that are worth denoting during our time in the presentation. As you see, the shareholder value is going to depend greatly on good investment and financing decisions, as these both lead to the addition to shareholder value. Financial ratios, as we alluded to a moment ago, help to measure the success and the soundness of each of these decisions. So that is an important aspect to keep in mind. One of the ways that we measure this is through various profitability ratios. Some of the more commonly profitability ratios that are used are return on assets, return on capital, and return on equity. Return on assets is nothing more than the earnings before interest and taxes divided by total assets. And you'll see each one of these is earnings before interest and taxes divided by long-term capital. With the exception of return on equity focuses on the net income divided by the amount of the shareholders' equity. Each of these are used to determine how well a firm's assets capital, and equity are being used to create revenue. Lastly, one of the things we will look at is ratio analysis, and the only area we will focus on during this presentation would be the liquidity ratios, as these are oftentimes thought of some as the most important. The liquidity ratio itself allows you to determine the firm's ability to convert assets into cash at a short notice. The most commonly used liquidity ratio is the current ratio depicted here, which is a firm's current assets divided by a firm's current liabilities, which would show you how many times the firm could liquidate their assets in order to cover their liabilities. Jumping down to the cash ratio, this is the same thing as the current ratio, except in the numerator, we are only using cash and marketable securities. Each of these can be used to determine the liquidity of a firm, which is a very important factor to keep into mind. As we're going through the remainder of the week, you'll see many other ratios used, so keep those in mind and refer back to this throughout the week for a quick refresher on some of these items. I hope that this has been helpful, and I hope everyone continues to do a great job in the class. Thank you for your time.